Welcome to Geared for Growth. I'm your host, Mike Mortlock from MCG Quantity Surveyors. And on this episode of Geared for Growth, we're digging into one of the most misunderstood yet incredibly powerful strategies in the Australian property landscape, renovation flipping. And we're doing it with someone uniquely positioned to cut through the noise. I'm joined by Heather Jordan, founder and director of MoneyWise Wealth Co. Heather isn't just an accountant with deep property tax expertise, though that alone makes her rare enough. She's also an experienced renovation flipper who has personally built a wealth journey around strategic flipping, asset protection, and helping everyday Australians break into property when they feel priced out. In this conversation, Heather debunks the myths around flipping, capital gains tax, structuring, finance, and feasibility. She explains why flipping still works, why townhouses are the ultimate first project, and why so many investors talk about flipping but never actually take action. If you've ever wondered whether flipping is still viable, how to structure it properly, or how real flippers find and execute profitable projects today, this is the episode you've been waiting for. Heather Jordan, thanks for joining me on Geared for Growth.
Thank you for having me. It's lovely to be here, Mike.
I've been looking forward to this one because you are, we talk about financial planners that work in property. They're kind of rare as hen's teeth, but you're an accountant that has a lot of experience in property, and that's a common Facebook request. Like, I'm looking for an accountant who understands property, and it seems like that is not exactly the norm when it comes to accountants. So where did your interest in property actually come from as a bean counter by trade?
Okay, so we can dive super deep on this one, and I can just give you the short version. So maybe the short version is that as a corporate accountant, I'm really good at what I did and made really good money, but I was also a single mum and had been since my daughter was 6 weeks old. And so I needed to figure out a way to actually bolster our household income, because there was no way I wanted my daughter to start life on the back foot, and I wanted her to be afforded all the opportunities. There was things that I wanted to achieve for her, and it was going to take more than what my wage was. And so that's how I got into property. I saw other people doing it. I didn't know anybody doing it in my circles, but saw other people doing it and thought, I need to chase that. I need to figure out what that is. And then fast forward to now, where I actually have a property accounting firm. That was because I found a gap in the market. So even though as a corporate accountant, I was really good at what I did, I still wanted to get advice out there on property accounting and property tax, because it wasn't what I did every day. And I didn't want to assume that I knew enough or knew everything. And I found it really difficult to get good advice. So I'm like, you know what? I'll do it myself.
Yeah.
And so that started off a journey, a couple of year journey. It didn't just happen overnight, but really starting to study property, understand property tax, and then how that can work with the entire wealth journey.
Excellent. So as a property accountant, what are your typical clients like? Are they portfolio builders, or do you work with individual mum and dads that are maybe looking at their first one, or do they have to be a bit bigger, like maybe they're running a business? Like, what's your sweet spot?
The sweet spot is people at the beginning of the journey. I really love taking people under my wing, or people who are saying, oh, I'll never be able to get into property, but wanting to. And I'm like, sure you can, I'll show you. That for me is the sweet spot. Like, I love being able to help people just approach it with a different frame of mind.
Beautiful. Now, your particular brand of property, if we were to pigeonhole you into a box of, are you a buy and hold? Are you a cash flow? Are you a capital growth? We would have to park you in the renovation and flipping side. Is that fair to say, or too simplistic?
It's very fair to say, because even though it's the simplistic side of building a portfolio, I feel like it's a fundamental side. And I will tell anybody who will listen to me that they should be doing flips at any part in their journey. Like, why not? Either you're going to be able to get into a property portfolio by getting some cash up front, or you're going to be able to pay down some quality assets that you do want to hold by getting that cash. To me, it's just a no-brainer. I love it.
It's interesting because if you were, let's say this was a question on a Facebook property forum, for example, like I'm an investor and I want to get involved in flipping. I presume that the top 9 of 10 comments would be, that doesn't really work anymore. Like the block's not based on reality. You know, you've got the costs of buying, and then you've got the capital gains tax and the stamp duty. And you probably haven't thought about that. So you really need to talk to a good accountant. Now, you are a good accountant. So you've got the opportunity to debate and debunk this hypothetical Facebook comment straight away.
I know. And do you know what? The one of the okay, not the last one because the last one was yesterday and it went a little bit wild and we can probably come back to that one. But do you know even in accounting circles, in the
Mm,
accounting Facebook groups, I get trolled for mentioning Renault flipping and I just go back to them and say, clearly you have never done it. You know, I've
mm,
got people in there saying that they're recommending to their clients to go bankrupt for 40,000. I'm like, wait, did you recommend learning how to reno flip? That debt can go away with one flip. And
mm,
then, I'll get oh, it's so easy, is it? Is it that easy? I'm like, well, I didn't say it was easy. I
mm.
just said it's an amazing return for the effort and what you can achieve from a really low starting point.
Yeah. But if we think about the numbers, let's just say I'll make some stuff up and I'll have to write it down because I'm not a maths
We'll write it
genius.
down too.
But let's say we buy a place for 500K and we spend 50K renovating it. Now, there's going to be some stamp duty in the mix there. There's going to be pest and building, blah, blah, blah. So we could say, I don't know, maybe it's a little bit conservative, but we're 600K all in. We sell that for 700K. We've got capital gains exposure on that 100K difference.
No.
No, because the reno would be reduced from that, right? See, this is why
Well,
it's
no
good to work
capital
with an accountant.
gains. No capital gains when you purchase to Renault Flip for profit. It's on
Aha.
revenue account. This is the one that goes wild. This is like whenever I say to
Excellent.
people, is that they will put in there, like you said, yeah, everybody who has learned from maybe, the local accountant at the pub or something like that, yeah, there's capital
Yep.
gains tax. And I just shoot back going, no capital gains tax if you have purchased with the intent to profit. And that
Right.
gets people angry. Like it really does go wild. And I just keep coming back and saying, no capital gains tax. It's in many ways it's worse because you're on revenue account, so it's profit is what you're going to be paying your tax on. So there's no main residence exemptions available, no 50% discounts available like you might get with CGT. So you
Mhm.
really need to make sure that you FISO in that tax on your profits.
So, how do we achieve this? Do we need to create a company that actually purchases the property that has some sort of capital gains tax exemption status because the intention to profit it? Talk us through the mechanics of that.
It's almost just like a business. You have to
Hmm.
treat it like a business, even if you're just doing it as a one-off profit-making activity. Even if you're small time, let's use that person who's just doing it to get rid of one debt, for example. Even
Yep.
if they're doing it, I would still prefer it be done in a company because at least whilst it's in a company, there are some things we can do around, if they are planning to continue reno flipping, we can retain profits and things like that. But in a company, you've got asset protection as well, which you
Mhm.
don't have as an individual. So you make a mistake on that reno, it can come back on you in the future. So you need to be really mindful about the structuring right from the beginning.
So let's just say we weren't. And I say, Heather, I just saw you on the Geared for Growth podcast and amazing timing. Last weekend, I bought an absolute shitbox in my personal name and I'm going to flip it. I'm going to make $1 squillion like you were talking about. Now, there's a problem there, right? Because we've got the structure wrong from the beginning, would you say?
Yeah, we do say like, so there's two sides. There's the asset protection side and then there's the tax side. So if
Yep.
you're a low income earner, your first couple of flips you probably could do in your own name. You're just
Hmm.
not going to have the asset protection. For me, that's really important. If you don't have any assets to protect, well, maybe that's not going to bother you. Maybe it's going to just be more easier, straightforward. Lending is going to be easier in your own name, things like that. But like I said, my preference would be considering a company just
Yep.
for that asset protection. And then for the opportunity that if you go on to do more flips, we can
Yep.
just do a little bit better with how we reinvest in future flips.
And either way, you can still have a CGT exemption, whether it's your personal name or a company.
No, because there's no capital gains tax. It's not on the capital account. So your revenue or the income that you earn from a flip is not a gain, it's a profit. So it's a
Yep.
revenue profit. So you're on revenue account and not on capital. So once you switch to revenue account, it's no longer capital, any of this type of exemptions are not available to you.
Interesting.
Yeah.
So is it considered almost a little bit like the property is kind of like trading stock
Correct.
rather than an asset?
Yeah. Yeah. In most cases, that
Interesting.
is what it is. You can still have it as an asset and then it still be treated as revenue, but now we're kind of getting a little bit complex and that, I don't want to scare people off, but what you said, let's stick with that. And then that's a
Yep.
great way for people to really understand what it looks like.
Yeah, the reason why I know about that is just because of the little bit of tax legislation that I have to understand as a quantity surveyor, and there were rules to say that you could purchase a brand new, let's say, investment unit that currently has a tenant in it because the developer is selling it as this package. Here is a brand new investment property already with a tenant in it, and that they're treating as trading stock, so they're not claiming depreciation on it. And if you purchase that within a 6-month period, then the assets aren't considered previously used, which would mean otherwise you would lose all the plant and equipment deductions. So that's the only reason that I know about that. But how prevalent is this knowledge out there that people can do a flip without CGT exposure?
Well, because they prefer the CGT exposure, it's really strange. So you've got the two schools of people. You've got the people who are scared of it, and then the people who realize that that's better than paying tax on the profit most of the time. So
Yep.
then you've got the people, once they learn what the consequence of no CGT is, then they desperately want to hold on to it. And to be honest, like there's flipping groups and property groups out there that in accountants that are giving people the wrong advice and suggesting that you can do some, pretty sneaky things like move a couple of your own items into the house, pretend to live there, and then you can claim it as your main residence and pay no tax, which is going to get people into trouble. And I would just
Yes.
prefer, like you've just run those numbers. If you're running a project and it's tight, you want to know if you're going to pay tax on that at some point, because it can still come back and bite you a couple of years' time.
So if we split it into two pathways, one is we have CGT exposure, but some of the benefits of that is that we could potentially claim some repairs and maintenance costs if we perhaps purchase it with a tenant in place and broadly satisfy that requirement to intention to rent as is. We could claim some depreciation expenses, whereas if we are putting ourselves in a structure or an environment where there is no CGT, I presume those things fall away. And what else? What are the other pros and cons?
I think lending is probably the bigger one. Is that putting it in different structures or telling lenders that this is a short-term project, that's when things can get quite tricky. And then you might end up having to go more down like the private equity, which can be really expensive and your
Yep.
project can fall over at that point. I think, by way of your holding costs, you can still claim holding costs throughout the project. It just looks a little bit different. But yeah, I really think the lending is the one that can make and break projects, because if you end up with private equity, it's 1.75% establishment fee plus a 1.75% other fee. And then there's a $5,000 brokerage fee. And then there's a 10% per annum fee on interest rate on top of that. And so you just got like fee on fee on fee, and that's where your projects will fall over even before you try and get a few claims in.
Okay, well, let's again try and split it into two. We talked about the company, but let's just say we'll take the example of someone that's potentially going bankrupt over 40K, but they've been given a lifeline by you to say, there's another way. What would that look like? How would they purchase the property? And perhaps with your experience, give us an idea about what is a reasonable amount to spend and what is a reasonable amount that we can get as a return on that spend. What does that look like? What would your advice look like?
Okay, for somebody in that situation, obviously there's some sort of debt exposure there. So I would be recommending they need to partner with somebody. They need to go and find a project and find somebody who'll put it in their name, and then they will take the profits that then they can settle on their debts. Because what you don't want to end up with is, some sort of caveat over the property whilst you're trying to sell it, or, somebody coming in and taking that property for you. Even if they've got any sort of defaults, they're not going to get loans anyway. If they are,
Yep.
it's going to be loan sharks, and then the project will never see the light of day. So I think for that person, they need to find a partner. And I would tell them that the process is going to be somewhere around 5 to 6 months. So they need to talk to whoever their creditors are and just say, okay, this is what I'm working on. This is obviously a much better outcome rather than you list a default against me or take me to court for a judgment. This is the process. And I work a lot with people with debts at those levels. And I can tell you, if you keep in contact with creditors, they will want to hold out. They don't want to punish people. They want to see a solution and they want to get their money. So,
well, that's the thing, isn't it? They want the money, and we've obviously been creditors for companies over the years that have gone into liquidation, and you tend to be a long way down the list. And luckily, our exposure is never that big, right? But they will be owing money to the ATO. They're going to get paid first. They're going to be owing money, huge sums, and quite often we either get nothing or cents on the dollar. So if we've got somebody saying, look, I want to come back out of this is my time frame, this is what I'm doing, in many respects it's kind of like, well, it's worth a shot, because there's a chance we get nothing anyway.
Yeah, there's a chance you get nothing or you go through an expensive court process. So wait it out 6 months, see if we can resurrect something out of this, whatever the situation is. And then you asked the second part of that question, and I can't remember what it was.
And look, to be honest, let's because that is quite a niche situation, and if anyone does have debts that they can't pay, then that they will need specific advice. They shouldn't be listening to a podcast to trade their way out of it. So to give you a little bit more latitude, let's just talk about someone that has an interest in building wealth, and they have watched the block, and they're kind of thinking flipping is the go. They've been talked out of it by people at barbecues. There's accountants that have told them, no, you're going to get smashed with CGT, so you're going to have to put $1 in and get $50 for every dollar, so it doesn't work anymore. Like, what would your advice be to that sort of person? The Geared for Growth Property Investing podcast is presented by our business, MCG Quantity Surveyors. If you're an investor or a property professional looking to get the best tax depreciation deductions for yourself or your clients, please get in touch with us at mcgqs.com.au. It's our mission to help as many property investors as we can to maximise their claims and maximise their property education as well.
Well, give it a try. That's always my advice. Like, do one yourself and then decide for yourself whether it's worth it or not. Like, we know going in what it's like. And of course, there's risk. There's risk in everything we do. But at least try it once yourself. And then you'll know for yourself if you want to continue, great. Like, you've learned a whole new skill set, a whole new income stream, a whole new way to provide for your family, to create either an income or wealth. Like, what is there to lose in that scenario of at least investigating it, learning for yourself what it takes, shadowing somebody. We allow people to shadow us on some of our projects when they're feeling really nervous about it. Like, how can you lose in that scenario? And then when you've got the knowledge, the confidence, and you have that team together and you've found a property, you've done your FISO, you've figured out your funding, and then just go ahead and flip it. Like to me, it's just, it really surprises me the amount of people who come to us every single week and say, "Oh, reno flipping, like I really want to try that, or I really thought about it," and they don't follow through. Like I think there's a lot of people interested but not committed to that financial outcome or to changing things for their family in a way that would push them from being interested into, "No, I'm committed to making this work." And
Yeah,
when
I
we get,
suppose that at the first hurdle, they might kind of think, oh, this is a bit too hard. Like, I don't want to set up a company, even though they might not even know what that costs or entails. They're like, it sounds like too much work.
yeah, sounds like too much work. But, like the very opening of our training, I will say you need to be a problem solver. If you're not a
Hmm.
problem solver, like if you just want to find problems and not work them through to a solution, it's not for you. But if
Yep.
you are somebody who goes, okay, challenge accepted, I'm going to figure this out, then it's definitely for you. Because that's what Reno flippers are. We solve a problem. We see
Yep.
something that has an issue. We see something nobody else does, and we can actually then make money out of that.
So, if we're wanting to get involved and we see ourselves as problem solvers, we get over that finance hurdle and we've got an opportunity. What is there a quintessential first project, like it should look something like this? Can you describe that?
No, you won't hear this from anybody else in the property industry. I've never heard anybody. This is what I would love people to do. Start with a townhouse.
Hmm.
The reason why I want people to start with a townhouse, there's multiple reasons, is one is the price point.
Yep.
Two is demand. There's always demand for that middle. Like, so you've got a high level of demand. And then the bigger one is that for your first project in a townhouse, you don't really have to worry about the external. Like the
Mm.
complex generally has rules and you can't touch the outside. So
Yep.
all of your effort and energy goes on the inside, which also means all of your reno costs can be concentrated on the inside. And so you can do something really beautiful and be able to deliver something to the market that is really beautiful without having to have the risk or money spent on lawn care and lawnscaping and fencing and roof soffits and all the kind of things that people don't notice.
Yep.
So that's for me. I would love to see everybody who's really feeling nervous about it just start there, dip your toes in right there. Worst case scenario, you're going to have a great investment on your hands if it doesn't sell, because
Yeah.
you already done your numbers. We already know how it works. We already know that it's going to have a great rental yield because we probably have either targeted families or investors before we even went into it. So, worst case, if it didn't sell, your money's stuck in the project. It's probably going to be somewhere around neutrally geared. I don't see too many downsides in that. Obviously, everybody's situation is different. If you've got money partners and it's, you're paying 20%, which I'm seeing at the moment for some money partners, maybe it's different. But at least in that scenario, if you're doing it yourself, yeah, start with a townhouse.
All right. Well, let's imagine a townhouse, and it's built in the very early '90s, and there are comparables for townhouses that are new or renovated that make us feel confident we've got some scope, that what we need to spend and what we can sell it for, there's a wide enough gap. I mean, firstly, is that a reasonable enough FISO? And then secondly, what are we doing that is giving the best bang for buck on a flip project?
Okay. But probably 90s might be too not early enough, because I
Okay.
feel like the things around the 90s are still selling for basically what a renovated property is. You need to take something maybe 60s. And of course,
60s. Okay.
anything pre 90s, the first thing everybody needs to think of is asbestos. So if you don't know
Hmm.
anything about asbestos and you want to go into Reno flipping, please go and find out. Um, but I think the 60s, and what we're noticing is that we are getting some great opportunities where somebody has lived in their house 15, 20 years. They're ready to, they're not really downsizing from a townhouse, but they can't manage stairs anymore, or they're wanting to, just move on to a retirement village, and they're not interested in renovating. They
Yep.
they love their home the way it was, with the green carpet and the black and white wallpaper that shines when you walk past it. They're happy with, all of the idiosyncrasies in their house, and some of them will even beg you to keep them as features after they're gone. Yeah. And what they're also wanting is to just take what they want and walk out. They don't even want
Yep.
to deal with some of the furniture or packing things. And so if you're prepared to take on something like that, that's where I think you're going to, well, not I think, I know that that's where the opportunities are at the moment.
Yeah, so in some respects, the upside is not just the reno. Okay, it looked like this, now it looks like that, but it's actually that is not a good sales campaign. An agent might say, "Look, if you just spend this, you'll get a hell of a lot more." They're like, "Not interested." And the agent might say, "We really need to get your furniture out of here," and they're like, "No."
Yeah.
Could we just take that wallpaper down? Not only are we not doing that, but I actually want to ask the purchasers if they'll keep it.
Yeah.
So this is where the transaction is going to be this is where it kind of feels a bit funny for me, because people say under market, but if it's a sales campaign and it sells on the open market, well, then that is
That's the
market.
market price.
I
Yes.
know, by
Right.
definition.
Yeah. Yeah.
However,
I'm with you.
it's not reasonably presented for a successful
Correct.
campaign, shall we say.
That's exactly it. So you can, especially in townhouses, you can have two right next door to each other, or even in apartment blocks. We tend to go away, like steer clear of big apartment blocks, because then you've got QBCC rules and things around apartment buildings. But townhouses, like, you can have the one next door that's been done up beautifully, and then yours, and they are selling just $180,000 apart. So you feel very confident going into it that, okay, we've got this, like, we can do something with this.
Yep. All right. Well, let's just say we've got a 180K gap. We're not worried about CGT. However, we do need to factor in agent selling costs, pest and building, the finance, establishment fees, that perhaps a return for money partners. On a 180K differential, how much can we really afford to spend to make this a worthwhile project, especially considering some of the time that we have to put in personally, which I feel like a lot of flippers will say, "Oh, I made 100 grand." I'm like, yeah, but you're on your hands and knees for 18 months, you know?
Yeah, yeah. So we don't do long flips. We also don't do short flips. Like
Mm.
the block thing, flips don't work like that. One, they seem to have like a never ending purse. And I should ask you what their depreciation schedules look like, because every time I look at one of those, I just think you've overcapitalized. Like, like,
Yeah.
this house costs more to build than what it's worth on the open market. Um, and so, yeah, with I don't know where I was going with that. With reno flipping though, we would need to be spending. It's just so hard. So we just not long did one, and the kitchen actually was fine. We just need to redo the doors. The
Yep.
actual kitchen had been done in recent years. It was just old, like older person style, and so
Yep.
it wasn't, like you said, it's not going to present to market properly. But there's nothing wrong with the kitchen. It's just that the style is not right. So we just reface all of the doors, and so
Yep.
then that's where we can save money. Every single time a bathroom will need to be redone, and then we can add a lot of value with a bathroom refit, make it
Yep.
nice, open, open shower, walk-in shower. Um, the flooring, that always needs to be done. The painting will always need to be done. I think the most simple thing that you can do in a flip project to add aesthetic value is replacing old yellowed electrical power points and light switches,
Yeah.
even
Yeah.
old yellowed air conditioners. Just the simple things like that really do devalue a property.
Yep. Yeah, those switches, they love to go yellow in age, don't they? It's like, I don't know, it's a bit like my grey hair that I'm trying to pretend doesn't exist.
Well, they get
That's the
yellow and
trajectory.
cracked, and maybe 7 times they've been painted, over a corner of them, and you just freshen all of those up, and it makes a huge difference.
Mm. Now, Heather, I'm not going to let you get off scot-free yet. I've still got speaker one for the negative hasn't wrapped up yet. We've got construction costs elevated since COVID. We've got a trades shortage. We've got construction insolvencies overrepresenting every other industry in Australia. We've got a huge pipeline of infrastructure works, and that's where all the money is. We've got rectification works for insurance. We've got fairly high resource costs, so there's lots of money in the mines. We're not going to be able to get tradies, and if we are, it's going to be scraping the barrel, and they're going to be $3,000 an hour.
Not true. It's not true. I understand that it's, maybe 60% you could attribute to that, but there's plenty of trades around who are begging for work.
Right. It's interesting because, I suppose some of those comments are macro Australia comments, but it's a bit like sort of saying Sydney has outperformed Melbourne. I'm like, well, great. I can't buy Sydney. I can't buy Melbourne. I can only buy in a suburb or in an LGA. And even then I have to buy a house or a townhouse or a unit. So to say that there's a trade shortage, well, there's going to be some areas where there's a surplus and some areas where there's not. Is there any way to get an understanding of the availability of trades, say, as part of the due diligence or the feasibility?
So we teach people to do like a 2-stage FISO, like your very quick one, like you and I did before, where we go, blah, 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 does this stack? And then we say, put in your offer, because offers are non-binding here in Queensland. And then between the agent figuring out the offer and it being accepted and going to contract, that's when you need to head down and tail up and now start shoring up all of your assumptions that you've put into your FISO. And so at that point there, you don't really want to be finding new trades. You want to either have a circle of trades that you're already familiar with. It doesn't work quite as easy as that. Like when we first started, that was our plan. We were going to use the same people every time, but their schedules don't always work with ours. And if we're doing one an hour away, they don't want to travel an hour away. We have paid people to travel when they're being good people, but it still doesn't always work. So I really think, so we do it this way. I'm very good with estimating costs, and the more you do this, the better you will get with it. So I wouldn't expect a newbie, but if this is what you want to do ongoing, then you will get good with estimating costs. The way that we operate is that we go out for just one quote. And if that one quote is in the ballpark of our budget or our estimate, we will just go with that trade. We don't get a second and third quote. Could we do better? Maybe, but we feel like the trades actually appreciate working more with you when they know that you're not scrappling around for a couple of dollars here and there. You just can say, yep.
This guy said he would do it for $20 a square meter, and you're doing it for 21 and a half.
Yeah, no, that would be the fastest way to, like you said, how do we find trades? That'd be the fastest way to lose them all. That would definitely word would get around. I find that they will recommend as well. And then this time of year, you can generally find ones who want to do some extra overtime and get some extra money into the family before Christmas and before they break up. So there's usually, like, this time of year is known to be a terrible time of year for trades, but we actually do okay with it because we're looking for a trade that knows that we'll work with them, that they can do their hours that work for them. Like, we're not expecting them between regular hours. Like, you want to come on a Saturday and Sunday because that works for you? Sure. It means that we get the work done. We haven't had to go searching for, 4 different quotes to find you. Let's do this.
Yep. Talk us through... Yeah, of course. Talk us through some of the typical results that you and your clients have seen, because there'll be some people kind of thinking like, okay, I'm all in. I'm going to make $1 million the next year because I'm going to try and do 8 concurrently. There'll be some people sort of saying, oh yeah, but even in that example, 180K upside with expenses, like that doesn't sound like a lot of money for the risk and the concern.
That's why I like townhouses. I feel like, nothing is de-risked, but it definitely reduces that risk. They're only 2 bedrooms, 1 bathroom, 1 kitchen. Like, how manageable is that. And I would say for the people who want $1 million, I think that they're better off maybe looking at subdivisions and just diving straight into that end, because I think you're right. Like, I think the more projects that you do, and if you're trying to do 8 in a year, that sounds to me quite risky. And I think you're going to be better off just go find yourself a piece of land, subdivide it. That way you've got a huge team of all your civil works and constructions and engineers that will do much of the heavy lifting for you. Whereas with a reno flip, it's you and the builder, like you and the builder, and then the builder organizes most of the trades. But that's, yeah, like I just don't see, oh, the 8. I don't like that. I just want somebody to dip their toe in, do the one, see how you go with that, and then let's figure out what you want to do after that. Maybe they do want to do houses and they'll end up with 200,000-300,000. They might even end up like significantly better than our model, which is maybe they'll make 500,000. There's plenty of properties being sold making 500,000 to $1 million after a renovation, but that scope is beyond what we do. We don't do rebuilds. We don't do major structural renovations, architectural type stuff. We just like keeping it super simple.
So what would a typical project would be that you would say, you know what, like that gets a pass mark?
It's going to be something small, manageable. It's going to be under 800,000. It's going to have multiple exit strategies. So if you don't sell at your price, what are the other options? Because we want selling at a loss to be like way down the list. We like to target 6 figures. So before tax of a 6-figure flip. So anything under that we think is too much effort and too much risk for the reward. Not everyone feels the same way we do, but that's just our model. That's what we like to do. I would say no structural work. I really think it is. It's going in, it's the under 800,000. It's the 2-bedroom, 1 bathroom, 1 garage, 1 kitchen, keeping it super simple and making sure that you can at least hit that 6 figures on the way out. No structural work. That would be.
And on something like that, typically what are we spending on the builder or the combined trades? How much would you typically need to tip in to get this to the point where you can start looking at those 6-figure upsides?
Yeah, it's about 35 to 40,000. That's the other thing I love so much about the townhouses, because it's just so contained. Very small. There's small kitchens, there's small bathrooms. You know, I see on the Facebook groups people go, "Oh, a bathroom, 25,000." Well, no, like not if it's a small bathroom. It's just not 25,000. Even with the builder doing it, like it's not 25,000. So
interesting. So there's often the reno sort of adages like that for every dollar you spend, you need $2 back. So, I mean, broadly, what we're talking about kind of fits within that. But I mean, if we're spending, 30K and we're getting 100K, then that's, I mean, I mentioned I'm not a maths genius before, but I know that surprises on the upside.
I've seen those numbers getting around. It's not what we encourage people. Like we don't look at percentages, because percentage won't tell you what you said before, the risk and the effort. A percentage just doesn't tell you risk and effort. And so we want you to have a look at the finishing number, knowing what the project is, and then making a decision. Is that number worth your risk and effort in this project? Then decide, because often, like you would just look at it, like there's projects that if there's $100,000 project with low risk, low effort versus $100,000 project with high risk, high effort, I mean, I want to be looking at the risk and the effort, not just go, oh yeah, like it's great. They're both 100,000. I'll take them both. Like I don't want to know about the high risk, high effort. It's just never going to be part of our model ever.
Yeah. Now we've talked a little bit about, okay, we spend X and we want to get Y at the end, but it's not just about the X versus Y. It's also about buying well. So we talked about a campaign that is probably not putting its best foot forward. There's also some other things, like the difference between buying in a market that has potential momentum already. There's also tapping into the demand locally. So that's where perhaps demographics comes in, where there might be a shortage of rental accommodation at that price point. There might be a shortage of these 2-bedroom, one bath, one car, simple types of properties. What else do we need to bend our minds to outside of, I'm going to do kitchen bathroom reno, it's going to cost X and I'm going to sell it for this much?
The neighborhood matters. Like the neighbors will matter. If you've got a neighborhood or neighbors with junk all over their yards, you can't change that. You can't go and knock on that neighbor's door and say, hey, by the way, I'm just about to sell this property. Do you mind having a cleanup?
I mean, that would be the sort of reality TV show I would watch, I think.
Good luck. Wouldn't it be ideal if you could do that? But I really think the neighborhood matters. Like we've just started kind of looking outside of the normal area. Like we really have loved doing them in the central Gold Coast. The trying to hit the kind of numbers is getting fewer and further between. That's not impossible. It's just not as many. And so we're starting to look a little bit outside. And so we're visiting areas that we're not as familiar with, like the Gold Coast, I know like the back of my hand, but these other areas. And when you go there, like you can't just decide online. You have to go and walk those streets. And some of them are terrifying. And you're like, oh no, this is not going to work. Even though the numbers might work, the risk of being able to sell it to somebody who can afford it, it's not going to work because you can just see that the neighbors are going to see that the house is for sale, probably muck up come sale day, or with people coming and going. You just know when there's a neighborhood that has some social issues, and you just need to steer clear of it. It's going to be that high risk.
Yeah. Now we've chucked a fair bit in 40 minutes already. And of course, there's a tremendous amount more people need to consider before they actually pull the trigger on something like this. But I think hopefully we've killed a few myths. We've got people thinking, oh, yeah, well, now that I know there's a way outside of CGT, then we're off to the races. What are the next steps that someone has to go from that idea and an interest in it to actually pulling off a positive project?
Oh. It's one of those things that I've been doing it for so long. Like I don't want to, have that, the bias, that knowledge bias where you assume everybody should know the things that you know. But I do want to share, like, it is not that hard. It's like anything you haven't done before. It's unfamiliar, and there's things that you need to learn to be able to execute on it. But I see people going to difficult jobs, mines, or sometimes even the office down the road, accounting office down the road, like difficult jobs, and they're doing it day in, day out. And I think if you can do that, you got this. Like you can make this happen. It's just the mindset that needs to change for them. I would love people to just take in that this isn't that hard, that it is worth a go, and to just try one. Just do it one time, and then make your decision. And stop listening to people who have never done it.
Yep. Yeah. And even accountants who have never done it.
Yeah, even accountants who have never done it. Yeah.
Because believe it or not, there are good and bad accountants, like there are good and bad people in every profession. Yeah. So, Heather, if people are wanting to get more information, perhaps chat to you, perhaps even work with you in a professional capacity, what's the best course of action for them?
Absolutely, yes. So you can email me direct on heather@jordanadvisory.com.au, or you can find me on Facebook, Heather Jordan. I'm always around. I'm always in the property circles. That's how we met. And so, often, like, I get text messages all the time. I do my best to respond to them. People often sending me, what do you think of this property, that property? I think they don't realize that I'm not actually a property, like, I'm a property accountant and I'm a reno flipper. I'm not a property strategist, but always happy to give them some direction, because that's what I needed. That's what we all need. And so just reach out and ask. And if I'm not the right person, I always find you the next right person to have a chat with.
I think they would be off to an incredible start by chatting to you. So thank you very much for sharing that information. And thanks for giving us a bit of a 101 into renovation. It's been eye-opening for me and for people that are looking to increase their financial wealth outside of just buying and holding or slowly building the investment properties, depending on what APRA's hitting them on the head with, then it's another strategy that they could have.
Exactly, yeah. Yeah, pay down that. Because the sooner you pay it down, the sooner you hit that elusive passive income figure that everybody's after. So I could just see a place for it in everybody's portfolio.
Awesome. Yeah. Thanks, Heather. Really appreciate it.
Thank you so much.
Cheers.
All right. Talk soon. Bye.